Welcome to this lecture example on section 31. It says A and B Limited are connected persons. A is a South African resident and B Limited is a non-resident company in a country where the income tax rate is 5%. Now already you need to see that we've got a connected person, we've got a resident and we've got a non-resident. Okay, so we need to start looking around and see if there's an affected transaction and so forth. So remember, an affected transaction is basically a transaction between connected persons, one which is a resident and the other one which is not a resident, and the transaction is not at arm's length. So let's look at it. It says, during the year of assessment, A purchased trading stock at a cost of 500,000 rands. Now guys, when we're doing these questions, we basically will just put in what they said that they did. So purchases section 11A, they would have claimed 500,000 rands as a deduction. Then it tells you the goods are usually sold for 1.2 million rands excluding VAT. But they sold it to B Limited for 610,000 rands. So they sold it, sale, for 610,000 rands. So that's recording what actually happened. Now we have to make our primary adjustment. So remember, the primary adjustment is just to fix the transaction. So that is section 31.2. So what is the primary adjustment? We should have sold it for 1.2 million rands, but we sold it for 610,000 rands. So 1.2 million minus 610,000 gives us the amount that we did not charge, what we should have charged. So that is 590,000 rands. Right, so that fixes it. So this thing calculates your taxable income for A. You then have to do your secondary adjustment, and you'll have to do this in the correct place. So this, in situation A is a company. If A is a company, we pay dividends tax. So what they do is they treat it as if that 590,000 rands there was a dividend in specie. Dividends tax rate is 20%. A dividend in specie, the company is responsible then for it. If A was not a company but a natural person, then you wouldn't do the dividends tax over here, you would have donations tax. But how would it work? It would work as follows. You would say, what is the value of the donation made? 590,000. You will still get your annual exemption or exclusion of 100,000 rands, or whatever is left. Right, so that gives us 490,000 rands, and that amount times our donations tax percentage. Right guys, simple as that. That's how it goes. Then example 2. It's a bit more of a discussion question, but just to show you. So A Limited is a South African company, so they've got a resident. B Limited is a non-resident company for a non-resident, and B Limited holds 51% of the shares in A Limited. So that makes it a connected person. Below is an extract from the statement of financial position. Right. So, and this is from A Limited, financial position for A Limited. It says they have capital, retained earnings, trade creditors, and a shareholders loan of 1.2 million rands. So note 1 says the shareholders loan is a loan from B Limited. Okay, so we got a loan from our connected person. The loan was made on the 1st of July 2026 and carries interest at a rate of 20%. Okay, so the interest A Limited had to pay for the first 6 months was correctly calculated as the following: 1.2 million, the amount of the loan, times 20%, the interest rate, times 184, half the year over 365. So they've calculated that they need to pay B Limited interest, or the owe B Limited interest of 120,986. Okay, so I want you to understand. So what is A Limited going to want to do? A Limited is going to want to say interest paid. I'll claim a deduction under section 11A, section 24J basically, and they will want to deduct 120,986. Okay, then I tell you An independent financial institution has indicated that it would have only been prepared to give A Limited 800,000 rand, so instead of 1.2, the market says we would have only given 800,000 rand, and we would have charged the prime lending rate of 11%, not 20%. So what they're saying is the market related interest would be 800,000 times 11% times we had it for half the year. So 44362. Right, and I just want you guys to see also, we do calculate it in the solution also, so you see where it comes from. Right, so basically, you should have only deducted that much. This is how much you did deduct. So your primary adjustment, section 31.2, will fix that. So 120,986 minus 44362 gives us the amount that we deducted too much. We should have only deducted 44,000, we deducted 120,000. So we'll add back 624. This will basically fix our situation, right? You can then have your taxable income. And then our secondary adjustment under section 31.3. This is a company, so they are treated as if they paid a dividend in specie of 76624. So the dividends tax will be 76624 times 20%. So guys, in this question, I ask you to do a discussion. So just to show you how you would set up your discussion, you would first talk about if there's an affected transaction in terms of section 31. When will there be an affected transaction? When there's a transaction between a resident and a non-resident, and there's a benefit for either or both of the taxpayers. Now in this case, A Limited can deduct the interest expense, and B Limited will not be taxed on it because they are non-resident, and non-residents receiving interest are fully exempt into section 10(1)H, if you remember. They are then also connected persons in relation to each other because they have 20% or more of the shares. So there are terms then which are not at arm's length, which they tell us. So that means that we have an affected transaction. So that's the first thing, is how you set it up with those points, as you can see. Now when you have identified the affected transaction, you apply basically what we do when we do the number crunch. We talk about the primary adjustment first. So let's talk about the primary adjustment. Section 31.2 is for the primary adjustment. So you basically say you should have paid only 44,362. So that means that 76624 is disallowed. We then talk about our secondary adjustment. Because as a company, it's a dividend in specie. So that 76624 amount times 20%. Right, then we just talk about when it's deemed to be paid by the end of the next month. Those are the rules for dividends tax.